Hi traders, good morning, good afternoon, good evening. I hope all of you are doing good. So we are back again with a video. Today we will analyze Bank Nifty first, and then we will talk about price action trading and some option strategies. So let's get started. As you can see, I am on a monthly chart, and last week we have marked these levels with the yellow lines, and I have added daily level with these dotted lines. So market is definitely in a bullish trend. The volumes are pretty decent, but this month's candle, 1st December till the 30th, the volume is not increasing, which is a worrying sign. So we are already in a zone where there is a lot of sell-off happening. So we have to wait and watch whether this candle will close positively or will it form a 50% candle, and it will show a sign of reversal. If this forms a 50% candle, then what we need to look out for is that the next candle, either it is going to start from here or drop down till here for retracement, or it can break and go above. So then this setup will be like a one leg candle, base candle, and another leg candle which is moving up. So it can be a rally base rally or a rally base drop. There are two scenarios which can happen next month. So let's analyze this on a weekly time frame. Weekly time frame, we have seen this was a complete red candle here. This was a red candle completely, but at the end of the day the candles became green because there was a lot of buying which has come during the end of the day. So let's see how it was on a daily time frame so that you can understand this. So this was the fall. The candle was red, and from there, from this point, so you can see from this point, this was a point, and this was a setup where after this candle closed, I had a downward position, but after this candle has formed, I closed my position and created position towards the upward side, because this is a very strong candle supported by good volume, so that the market can continue to trend. Now my gut feel says that there is a resistance at this level. Okay, at least some part of a retracement will happen from here. So I have a downward little bit downward position, unidirectional. So let's see how it goes, and I am expecting a small retracement here, which can be on a daily time frame. And once I get a confirmation, then I will wait for the another candle to form, and then maybe if that breaks the high of this candle, then I will go long here. So let's see this on a 3-minute time frame. On a 3-minute time frame, market opened up, gap up above VWAP, started moving up, broke the super trend here, touched VWAP again, and then touched VWAP again. So what do you notice? See, whenever the market is in uptrend, the price will be above VWAP, and you need to wait for an entry till it touches VWAP. This will be your entry point, and that too with a candle, a green candle taking out a red bar like this. Only in this scenario you can do a naked call buy or future buy. That kind of setup is this one, with your stop loss below this. But if you are trading in options, then you can always create an upward bias, stating that you can create a hedged position and it can continue to go up. If the market starts going up further also, it will be in profit. Here there was a resistance at this line, the market couldn't cross that. Let's see, it has taken a retracement here, and if it moves up from here, definitely there will be a big move which is awaited. So this is on a daily time frame. So if you see the option data for Bank Nifty, This is my own tool which I have created. You can see that highest open interest is at 31,000, 31,500, then 30,500, then 30,000, then 29,500. So people have actually you can do a lot of strangles like this with the highest open interest by hedging it with a calendar spread. So for example, if you are doing a 31,000 call sell and a 30,000 put sell, then you buy the same strike for the next month. Let me show how to do that. So what do we have to do? For example, we have identified that 31,000 and 30,000. Let's take these two strikes. So here 31,000 call, we are going to sell one lot, and 30,000 put, we are going to sell another lot. Okay, so this is my position. It has about 300 plus 300, 600 point range we are having. Now it's better to be precise. 31301 minus 29699. Okay, it's a 1600 point width what we are having. So that means if the market moves anywhere in this 1600 point range, the only loss you're going to have till this point is 4,914 or 5,870. Okay, this will change on a daily basis, this T plus 0 line. This is for next day or today's PNL line. So your maximum profit can be 7,545, but maximum loss if the market happens to move either sides, any unforeseen event happens, like it gaps down, crashes, then in that case you will lose a lot of money here, like 13,000, 14,000. So what is a better way to do this strategy is to hedge it with the next month first week position buy. I am going to add the same 31,000 call here, and I will buy a position of 7th Jan. Okay, so now look at the position. The maximum loss is defined now. It is 10,424. Maximum profit is about 3,700. And what is the range we are having? 29810 minus 31255. So we have a range of about 1445 points. So market remains in this 1400 points, you will definitely make this money, which is 3,000. This is the money you're going to make. And if it moves any unforeseen event, which is likely to happen very less probability, maybe 5 or 8% chance. So in that scenario, you're going to lose this money. Otherwise, this is safe. And this is only a one lot position which we have added. Now, if you want to look at the Greeks for this, see, your delta is positive, your theta is positive. That means you're also getting a time decay factor. Your gamma is slightly negative, which is not going to hurt you. Your vega is also positive. Now if I change this to monthly, say for example, I will take it to monthly expiry and modify it. So what we are doing here is we are selling 31st December call and put and buying a 28th Jan call and put, which is our monthly strike. Okay, so here you are going to make a maximum loss of 33,000, maximum profit of 5,400, and the level and the width of the entire strategy remains the same, 1400. But this is not showing good because maximum loss is higher in this, because the premiums are pretty high here. So what do we have to do is we will switch to the same setup. Jan setup is much better because the closest one will have proper premiums for us to hedge. So now this is hedging us properly, and maximum profit is about 3,700 and maximum loss is about 10,424. So in this strategy, if you are saying that market will go up, then you have to take a little bit closer. Like we have taken a 30,000, 3,100, right? So we can actually take a 30,000, say for example 500, let's look at the option chain first. I will select 31st December. So here we have taken 31,000 and 30,000. So what we can do is 31,000, then we can actually do a 31,500 instead of this. What you do is you do 31,500 and see how this will look. So on the downside, you have a better width if the market starts going down. Okay, similarly, if you want to do it on the upside, what you need to do is instead of 30,000 put buy, you can actually buy a 29,500. So buy a 29,500 put. Now you see your bias is towards upside, so there is a bigger room for you, so that market goes up, your profit will be up here, but at the same time your loss will be higher. From this point immediately there is a drop, and within like 100 points your loss will start coming in. So that is not the right way. The right way is to have it equal and hedge it there, and if you see any movement happening, close. If it comes close to any of your edges, then close the strategy and create a new strategy. So but your loss will be always limited and reward is also limited in this strategy. So these are called calendar spreads, and you can definitely, the one variation which I showed is diagonal calendars. So these are variations which you can try, but these are all different names and concept. But the best way for you to have your own strategy is to keep playing with this payoff charts and try to make your own strategy and see how it looks. So I prefer doing butterflies, and butterflies have been really simple, and butterflies or iron flies, both are good for me. This is one trade which I'm holding right now. So this is max loss is about 1600, max profit is about 5800. What we have done, we have sold a 30,300 call and put, which is a straddle, and then hedged it with the 30,100 put and 30,600 call. My loss is 1600 if the market goes up. If the market goes down, maximum profit is 5800. So my view is that market will at least come down till 30,200, 250. So this is what I'm expecting. The moment market opens up, then in this territory I will quickly square off this position and then make a position basis the market direction. Okay, so that's it for this week, guys. Hope you have liked my video, And if you keep following my channel, the learning process will improve for you on a regular basis, and